What's going on, everybody? What's going on, everybody? I hope everybody is doing well. Today is another day in the market. We were green today, but do not be fooled by that. Setting everything up on Instagram. What's good, Instagram? Hope everybody is doing well today. It was good to see some green, but like I said, don't be fooled by that. We are going to get into why I feel that way, but okay. Appreciate everybody for letting me get everything together real quickly here. All right, everybody. So if you don't know me, I want to introduce myself again. My name is Devon Elder. I'm a 28-year-old civil engineer, and I am the host of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade for yourself. Please like, please subscribe. Make sure you hit that notification bell so you can be in the know every time I drop an episode. Okay, disclaimer. Okay, I am not a financial advisor, nor am I a fiduciary. Okay, I do not manage money professionally. So please do your own research before investing into any stock, option, bonds, whatever security. Please do your own research. My goal is to help teach you, but you still got to be able to learn how to research for yourself. Now, I want to let everybody know about my website that I just launched. I just launched my website, www.tradeforyourself.com, where you can go and you can purchase this merch right here. Okay, the Trade for Yourself merch. As you can see, the shirt says, don't pay for it, trade for it. Okay, we've got so many different colors over there. We've got red, we've got blue, we've got gold. Okay, understand what this shirt means. Well, what this shirt means is that, okay, I want people to understand that I want you to be able to go into the market, and I want you to allow the profits that you get from the stock market to pay for whatever you need. Okay, so if you want to support the podcast, if you want to support me, please go to www.tradeforyourself.com and go over there and get you a t-shirt. Okay, so let's go ahead and get into this episode and get into the reason why we are doing this podcast episode in the first place. Why is the stock market still crashing? Okay, now there's a couple of different reasons why we can say why the stock market is crashing. Inflation is a main reason, but also the Federal Reserve raising interest rates is the main reason why the stock market is crashing. Okay, so if you're on Instagram, please come over to YouTube, because I'm going to be sharing my screen here. I'm going to be going over what the Federal Reserve did for us here today. Now, let me get this screen going here. Let me get this screen. Now, as you can see, I've got the S&P 500 here up right now, but we're gonna hold off on the charts right now. Okay, we're gonna hold off on the charts, and the first thing we're gonna do is we're gonna go to CNBC.com. We're gonna go through what happened with the Federal Reserve today. Okay, so Powell said that the Fed could hike rates by 0.75 percentage points again in July. Now, me personally, I've been in the stock market, okay, for about 2 years now. And what really truly got me interested in the stock market was going through the companies, okay, understanding the companies, understanding the balance sheets, understanding the products and the services that the companies use, understanding the CEOs, understanding what the stock market is and why it's important to me, understanding the companies that I use, you know what I'm saying, and being able to invest in those companies. But this year, this made me understand that in order for me to be successful and be a dope investor in the stock market, I'm going to have to get into my economic analysis bag. Okay, I'm going to have to be able to learn these economics. I'm going to have to learn interest rates. I'm gonna have to learn currency, how the dollar is moving. I'm gonna have to understand inventories and so many different things in order for me able to really truly understand what's going on here in the stock market. Now, shout out to my Instagram family. Instagram, please come over to YouTube so you can understand what we're going through some articles and everything like that. So please come on over to the Trade for Yourself podcast over here on YouTube so we can share screens over here so you can see what we're going through. Now, as we know, Jerome Powell, he is the chairman of the Federal Reserve, and he said that the Fed could hike rates by 0.75 percentage points again in July. Okay, so Federal Reserve Chair Jerome Powell said Wednesday the central bank could raise interest rates by a similar magnitude at the next policy meeting in July. Okay, so we got 75 basis points here today, and we're going to get 75 in July. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. Now, okay, we're going to go through everything. We're going to go through what all this means. Okay, so Federal Reserve Chair Jerome Powell said Wednesday the central bank could raise interest rates by a similar magnitude at the next policy meeting in July as it did in June. So pretty much 75 basis points today, 75 basis points next month. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on incoming data and evolving outlook on the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. Now, understand what he said. This is the first time since 1994 that the Federal Reserve has raised interest rates by 75 basis points. I'm going to tell you something real nice here. 1994 was a wonderful, outstanding year. Why? Because I was born in 1994. Okay. I was born in 1994. Now, after that happened, the stock market went on a crazy run through the end of 94 into 95. Those were some of the best years in the 90s in terms of performance in the S&P 500. Now, the central bank on Wednesday raised benchmark interest rates by 0.75 of a percentage point to a range of 1.5 to 1.75, the most aggressive hike since 1994, hence what I just said. Powell leaving the door open to another big increase came as a positive surprise to markets as many investors urged the Fed chief to show his seriousness in combating surging prices. Okay, so let's go ahead and stop right here because we need to break down. And I really, truly feel like a broken record because the last month, last 2 months, last 3 months, like I said, we've been having to get into that economic analysis bag. So very quickly, let's review. What is the Federal Reserve? The Federal Reserve is the central bank of the United States. Okay, so the Federal Reserve has a dual mandate. So they're responsible for two things. They're responsible for maximum employment, and they're responsible for price stability, i.e. controlling inflation. So the Federal Reserve is raising interest rates in an attempt to slow inflation, okay, because price stability is a part of their mandate. Now, with inflation continuing to increase, they have to raise interest rates. Now, this is why the stock market is crashing. The stock market is crashing because of inflation, okay? Inflation, okay? High inflation, the highest inflation that we've been dealing with since 1981. That's an issue, okay? But the one thing that I will say is that there's some macroeconomic things going on globally that the Fed might not be able to tackle by itself, okay? With the price of oil being so high, why is the price of oil so high? The price of oil is so high because of the war that we have going on in Ukraine. Okay, understand that we have food prices going on so high. Why are food prices so high? Because I want to say that there is about 30 to 40% of the global wheat production that comes out of Ukraine. Ukraine's going through a war. That's a problem. Somebody please fact check me on how much wheat comes out of Ukraine. Okay, so we understand also that China has been going through a COVID zero lockdown. Okay, most of our major American companies operate and do manufacturing out there in China. Okay, so we are going to be importing a lot of goods from China, a lot of goods from India, a lot of goods from Vietnam. So pretty much overseas, where we're inputting goods overseas, the United States of America is not exporting that many goods on a global level. So if China is on a global lockdown, that is going to be able to slow their economic output. That is going to pretty much it's not going to help out our supply chain issue. So the supply chain is also really truly coming into an issue whenever we're dealing with this inflation. So the Federal Reserve is really truly trying to accomplish that dual mandate, is trying to accomplish that inflation, because this is the thing. The stock market is not going to move higher until we get this inflation to come down. Now, is it a possibility that the inflation could come down? Yes, 100%. It's a possibility. But what is it going to take? How long is Putin going to be in Ukraine? When is COVID going to not be an issue over there in China? Let me know. Please, I don't have a crystal ball. Please let me know so I can prepare for my portfolio. But nonetheless, I still got to do the research. Why? That's why I said I got to get into my economic analysis bag. Look, I love talking about Tesla and Apple and Amazon and what they're doing in the future, but we can't get to the future if I don't understand what they're doing economically. So this is why we're going through the Federal Reserve, going through, you know what I'm saying, what the Fed chair said. Now, let's get back into the article. So major equity averages jumped to session highs after Powell's remarks. Okay, so Pershing Square's Bill Ackman. Okay, Bill Ackman said earlier this week that the Fed has allowed inflation to get out of control. Equity and credit markets have therefore lost confidence in the Fed. I don't disagree with that statement. Ackman called on the central bank to act more aggressively to restore market confidence, saying a series of 1% hikes would be more efficient in tamping down inflation. The Fed's move wins that comes with inflation running at its fastest pace in more than 40 years, hence what I just said. The Federal Open Market Committee said in a statement that it is strongly committed to returning inflation to its 2% objective. Okay, so this last paragraph right here, according to the dot plot of individual members' expectations, the Fed's benchmark rate will end the year at 3.4%, an upward revision of 1.5 percentage points from the March estimate. The committee sees the rate rising to 3.8% in 2023, a full percentage point higher than what was seen earlier this year. We will, however, make our decisions meeting by meeting and will continue to communicate our thinking as clearly as we can. Now, this is what we got to understand here, okay? The Fed is pulling out all the stops. They're pulling out all the stops to really, truly try to control this inflation. Now, Bill Ackman is a respected investor out here in these Wall Street streets, okay? He's very respected. And what he said was true. The Fed moved too slow. Okay, they moved too slow. They should have been trying to curb inflation last year, but they were saying that it was transitory. They kept using the term transitory. Okay, so what does transitory even mean? All transitory means is just temporary. They thought inflation was temporary, but it wasn't true. It wasn't true. So this is the one thing that I really like, and I really truly want to get deeper into this tonight. Please, everybody on Instagram, please come over here to YouTube so you can see what I got going on over here. I appreciate everybody on YouTube. I appreciate everybody on Instagram so we can really, truly break this thing down. Okay, let's break this thing down. Okay, so the one thing that I really want us to get through tonight, okay, the one thing I really, truly want you to understand and take away tonight, what does the Federal Reserve 0.75 percentage point rate hike mean for you? Okay, what does it really truly mean for you? We understand what it means for the stock market, but what does it mean for you from an everyday perspective? Because most people don't think about the Federal Reserve. I'm gonna be 100% honest with you. I told you that I was actively investing into the stock market about 2 years ago. Before that, I was not concerned about interest rate hikes. Okay. I was not concerned about the 10-year treasury note yield. I wasn't concerned about, the dollar versus the yen versus the won versus the pound. I wasn't concerned about that. But now, as an investor, I understand that the Federal Reserve has the biggest influence on the stock market because they control interest rates, and interest rates control the ability for people to gain capital. Okay, so for people to gain capital for investment. Okay, we understand mortgage rates and things like that. So let's break down and let's go up into this article and understand what's going on here. All right, so the Federal Reserve raises target federal funds rate by 0.75 percentage point, the largest increase in nearly 3 decades, okay, in an effort to quell runaway inflation. Now, what is the federal funds rate? Okay, so the federal funds rate is pretty much the standard rate, but you can look at it also as the overnight lending rate. Okay, the overnight lending rate that banks use to loan money to each other. Now, why would banks need to loan money to each other? Banks would need to loan money to each other because, okay, the United States government mandates that banks have a certain amount of cash flow in their reserves. Okay, if those reserves are depleted from a bank, a bank could borrow some money from another bank in order to be able to make sure that those reserves get back up to that level where they need to be. Okay, so the Fed can control that and pretty much control what banks charge pretty much between each other to borrow money. Now, we at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. The latest move is only one part of a rate hiking cycle, which aims to crush inflation without tipping the economy into a recession, as some fear could happen. Now, I truly believe that we are going into a recession. Okay, I don't know when the official numbers for the recession will occur, but the one thing I'm telling you is that these bond rates are very high and the yield curves are inverting. Okay, so we're going to talk about the yield curves inverting in a little bit, but understand that we will be going into this recession. What's a good way for us to really truly understand what the recession is? Okay, we need to be able to lower our expenses. We need to build our cash flow and understand that we need to purchase assets that we can hold over the long term. Now, what does the federal funds rate mean to you? The federal funds rate, which is set by the central bank, is the interest rate at which banks borrow and lend to one another overnight. Well, guess what? That's exactly what I said, right? You see, that's exactly what they do. You see, because we have to understand that the banks control the economy. As I say before, and as I'll say again, the Federal Reserve is the biggest influence on the stock market. Okay, now understand something here. We're certainly going to see the cost of borrowing escalate relatively quickly. Okay, so with the backdrop of rising rates and future economic uncertainty, consumers should be taking specific steps to stabilize their finances, including paying down debt, especially costly credit card and other variable rate debt, and increasing savings, said Greg McBride, chief financial analyst at bankrate.com. Okay, so what we need to understand is that federal funds rate, although it is not the rate that you may pay, the Fed move still affects the borrowing and saving rates consumers see every day. Okay, so what's the next thing? Pay down high rate debt. Since most credit cards have a variable interest rate, there is a direct connection to the Fed's benchmark. So short-term borrowing rates are already heading higher. Credit card rates are currently 16.61% on average, significantly higher than nearly every other consumer loan, and really may be close to 19% by the end of the year, especially if the Fed continues to raise interest rates, which I will believe that they will be able to do, because I don't think that they're going to be able to lower inflation really until the end of the year. Inflation will come back down and it will regulate, but it's going to take a while. It's really going to take a while. So if you're carrying a balance, try consolidating and paying off high interest credit cards with a lower interest home equity loan or personal loan, or switch to an interest-free balance transfer credit card. So consumers with an adjustable rate mortgage or home equity lines of credit may also want to switch to a fixed rate. Now, because longer term 15-year and 30-year mortgage rates are fixed and tied to treasury yields and the broader economy, those homeowners won't be immediately impacted by a rate hike. Now, one thing that I learned from some of my mentors is that if you have a fixed rate mortgage and you were able to get that fixed rate mortgage before the pandemic or right at the low of the pandemic, that is really kind of like a hedge against inflation, because you know that every single month what your monthly payment is going to be. So as rent is increasing, as the cost of borrowing is increasing, as home prices are increasing, your mortgage payment is staying exactly the same. So technically, it's a hedge against inflation, and it could be an opportunity for you to be able to access some of that equity in your home to be able to, invest in other places, invest in other areas to be able to create another form of passive income. Okay, that's what we got to understand. If we want to build wealth, if we want to build wealth, and if we're going to borrow money, we have to borrow money to be able to create another source of passive income to be able to buy assets. Okay, that's what we have to do, because wealthy people borrow money at low interest rates to be able to create passive income to purchase assets. That's what we really truly need to understand. Now, the average interest rate for a 30-year fixed rate mortgage is also on the rise, reaching 6.28% this week, up more than 3 full percentage points from 3.11% at the end of December. Now, that is dramatic. That is mostly due to the increase in the bond yields, because the stock market is down 20%. Okay, so we're in a bear market from a stock market perspective, but the bond market isn't doing too hot either. So that's what you got to keep in mind as well. Given that they've already gone up so dramatically, it's difficult to say just how much higher mortgage rates will go by year's end, because I still think that people are going to be buying homes because supply is low. The housing market is not going to crash, in my opinion. So keep that in mind. Now, even though auto loans are fixed, payments are getting bigger because the price for all cars are rising because of the semiconductor shortage. So if you're planning to finance a new car, you'll shell out more in the months ahead. Federal student loan rates are also fixed, so most borrowers won't be impacted immediately by a rate hike. However, if you have a private loan, those loans may be fixed or have a variable rate tied to LIBOR, prime, or T-bill rates, which means as the Fed raises rates, borrowers will likely pay more in interest, although how much more will vary by the benchmark. So this may be a good time to see if refinancing makes sense, but to be completely honest with you, for full disclosure, I'll just give you my particular situation. I have a mortgage and my interest rate is about 4.875%. Right now, like what did we just say? We said that the fixed rate is 6.28%. So somebody with an 800 credit score right now can only get a 6.28% mortgage, and they're paying more than me. Okay, so put that into perspective and really truly understand how high mortgage rates have gone. So understand what you need to do from a mortgage rate perspective. Okay, so hunt for higher savings rates, being able to have some cash. Yes, that's good. Have some cash on the side. Okay, have some cash on the side. Now, while the Fed has no direct influence on deposit rates, they tend to be correlated to changes in the target federal funds rate. As a result, the savings account rates at some of the largest retail banks are barely above rock bottom, currently a mere 0.07% on average. You're not going to get a return in a savings account. Okay, that's why we're investing in the stock market. But you do need a little bit of cash on the side to be able to, pay for things we need to pay for them. Okay, so the rates paid by bigger banks are largely unchanged. So where you have your savings rate is really important. Okay, so the average online account is closer to 1%, much higher than the average rate from a traditional brick and mortar bank. One thing I will tell you is that if you have a Robinhood brokerage account, you can put cash over into that account and you will gain 1% annually just for having the cash in the account. So keep that in mind if you're trying to build you a cash position or something like that, so you can have you some cash on the side to be able to invest in the market when you need to. Okay, so we've got some top yielding certificates of deposit, which pay about 1.5%. These inflation protected assets backed by the federal government are nearly risk-free and pay 9.62% annual rate through October, the highest yield on record. So keep that in mind. If you are a bond investor, if you're closer to retirement and you need to mitigate your risk from a portfolio perspective, park some money over here, in a T-bill. Okay, park some money over here, you know what I'm saying, to make sure that you continue to get an increase, make sure you continue to get a return from a risk-free asset, i.e. pretty much a bond that is backed by the United States government. So now, lastly, what's coming next for interest rates? Consumers should prepare for even higher interest rates in the coming months. Even though the Fed has already raised rates multiple times this year, more hikes are on the horizon as the central bank grapples with what? Inflation. While expectations for those increases have been quarter or half-point hikes at each meeting, the central bank could hand out further 50 or 75 basis point increases if inflation doesn't start to cool down. Now, the one thing that I heard from Jerome Powell when he was speaking today at the conference, he said that he is going to be committed to controlling inflation. So don't be surprised if we get 75 basis points again in July. And don't be surprised if we get 75 again in September. Now, the Fed is not going to be forward-looking. They're not going to anticipate inflation or anticipate what's going on. They are not going to do that. They're going to be data dependent. So what are they going to be watching? They're going to be watching CPI. They're going to be watching PCE. They're going to be watching the PPI. They're going to be watching all of these different metrics to determine what inflation is doing. They're going to be watching retail sales. They're going to be watching jobless claims. They're going to be watching the increase in the jobs and that non-farm payroll. So the Fed, they're going to be watching those things before they decide what they're going to do from month to month. Because I promise you, if that CPI rating that came out last Friday was not 8.6, if it was more so somewhere around 7.9, 7.8, they probably would have raised only 50 basis points, and they probably wouldn't have raised 75. But the investors really, truly put their feet to the fire and made them do that 75. Because if they would have only done 50, it really, truly would have put the narrative and the message out there that the Fed has no idea what they got going on. They have no idea what they got going on, and they think that inflation is just going to subside by itself. So understand that and keep that in mind as we're looking at these interest rates, and understand we're not going back to all-time highs until that inflation comes down. So we got to get that inflation to come down, and the Fed is really, truly trying to use all its tools in its toolbox in order to be able to get that to happen. Now, before we get out of here, I always like to go to marketwatch.com. And the reason why I like to go here is because it lets me know the upcoming economic calendar, the upcoming economic calendar for the U.S. Now, today we had our Fed funds statement. They gave us the rate. We don't got to keep belaboring that. So tomorrow we'll have initial jobless claims coming out tomorrow. That might move the market. We'll see. We've got Philadelphia Fed manufacturing index that might move the market. I don't really truly anticipate that much. Friday, we've got Fed Chair Jerome Powell gives welcoming remarks at Fed conference on the dollar. So this might be something you might want to tap into. Tap into really truly learning about the dollar, learn about how the dollar moves, learn about how the dollar is affected based on other currencies outside the US. So I really like to come here and see what's going to be going on from an economic standpoint, because it can definitely affect me if I want to get into a trade, or any of my traders out here that are tapping into the Trade for Yourself podcast. So Monday, we got Juneteenth. Shout out to the ancestors. That's going to be a federal holiday. The market's going to be closed. Tuesday, we've got existing home sales. I don't see us moving that much off of that. We've got initial jobless claims again. We've got U.S. manufacturing PMI. That may be a big number. So keep that Keep that in mind. And then we've got consumer sentiment index. So, and we've got 5-year inflation expectations, but I don't really see that moving the market that much. So, we got past this Fed meeting. So the next 2 weeks may be a little light for us. So this may be an opportunity for us to get back into our company bag, okay? Get back into our fundamental analysis bag from a company standpoint and see where we can find some companies at some good prices, that are good fundamentally and good technically. So before we get out of here, I really love to go over the charts real quick. So I'm gonna go over the chart really quickly to let us know where we are. So this is a weekly chart of the S&P 500, and we are in a bear market. And as you can see, we are in a defined downtrend. When I look at this chart, how do I know that we are in a defined downtrend? Because we had an all-time high back here the week of January 3rd. And we've had a series of lower highs and lower lows. So we came down, we had a low, then we had a high, and then we came down to a lower low. We broke back up to a lower high, and we came back down to a lower low, and now we hit another 52-week low again. So I'm gonna draw my little info line here just to go ahead and drop this and see how far we're down. On the S&P 500, as of the close of today, we're down right at 20.97, really almost 21%. So we're still in the bear market. If we look at where we were a few days ago, we were down as much as 22.83%. So we were way down there. So understand this. When the S&P 500 hits a 52-week low, that's an opportunity for you to start a position. I'm not telling you that the market can't come down lower. I'm not telling you that. That's not what I'm telling you. What I'm telling you is that you got to be able to stay in for the long term. We're building wealth over the long term. I'm not really truly that much worried about where the S&P is trading tomorrow or Friday or August 15th for that matter. I'm not that concerned. Okay, yes, I got some positions that are down big. Yeah, but it doesn't worry me. It doesn't worry me at all because I understand that I have to be rooted in the long term. So I'm really truly about to get out of y'all's hair real quickly. So for everybody that's been tapping in with me, I appreciate y'all. Please give me a like. Please subscribe. Please reach out to me if you have any questions. Look, if you have any questions, go to www.tradeforyourself.com. I really, truly want to do a special Q&A episode for the podcast to be able to give you guys a tool that you need in order to be successful in the market. Go to www.tradeforyourself.com to get yourself some merch. Don't pay for it, trade for it. If you already got one shirt, grab you another one. Sure, if you got 2 of them, grab you 3. Like, grab as many as you need and disperse them to your tribe. Because I really truly want people to know, don't pay for it, trade for it. And all that means is that, look, I just want you to let the market pay for everything. I want you to understand that the stock market is a tool for us to build generational wealth. The stock market is a tool for us to be able to build what we want to build, to be able to create the life and design the life that we want. So again, thank y'all for tapping in with me. I'll see y'all again next week. And remember, don't pay for it. Trade for it.